Is Surya Binti Jumali. Today, my team and I will be presenting about the curbing tax avoidance, assessing the case for consolidated group taxations of multinational corporations. So here is some brief introduction what we're going to present today. The first point is about globalization, where it has enabled multinational corporations to operate across multiple countries and tax jurisdictions. While this expansion has increased efficiency and global trade, it has also created challenges for national tax systems, right? And the difference in tax laws and tax rates between countries allows some multinational firms to reduce their overall tax burden through profit shifting strategies. And these practices can significantly limit the tax revenue collected by the governments. Also, the transfer pricing is one of the most common used methods to move profits to low tax countries. So, about the transfer pricing, my teammates will explain further in the next slide. And yeah, under this approach, profits would be assessed based on the economic activity of the entire corporate group rather than individual entities. So this method aims to limit profit shifting, improve tax transparency, and ensure corporations pay a fair share of tax in Australia.
Hello everyone. Today I'm going to talk about a very important issue in business ethics, transfer pricing. Basically, transfer pricing happens when different branches of the same multinational company sell goods or services to each other. For example, if Apple in the US sells a patent to Apple in Australia, the price they choose is the transfer price. In theory, this is legal and should follow the arm's length rule. This means companies should act as if they are separate and independent businesses. However, the real purpose for big companies is to shift profits. They move money from countries with high taxes, like Australia, to countries with low or no taxes, often called tax havens. How profits are shifted. So how exactly do they do this? There are two main ways shown on this slide. The first is price manipulation. A company in a high-tax country might pay a very high price for services from its own branch in a low-tax country. This makes the costs very high in the high-tax country, so the profits look smaller and they pay less tax there. Second is the IP strategy, which stands for intellectual property. Companies register their patents or trademarks in tax havens. Then the branches in other countries must pay massive royalties or fees to use them. The result is always the same. High costs in high tax areas equal lower taxes for the company. This keeps the more money in the company's pockets and away from the government. Why regulation is hard? You might ask, why don't government just stop this? Well, as this slide shows, regulation is very difficult. One reason is complexity. The rules are very hard to enforce globally because every country has different laws. There is also a valuation gap. It is easy to know the price of a car, but how do you decide the market price for a unique software or a brand logo? It's very subjective. Finally, companies exploit weak rules. They look for small difference between countries' laws to find loopholes. Because of this, even if it feels wrong, it is often technically legal. Finally, let's look at why this is an ethical problem. First, it is unfair. Big companies pay very little tax, while small business and normal people pay their full share. Second, it causes a public loss. When companies hit their profits, the government has less money for hospitals and schools. Ethically, it is wrong for a company to use a country's resources but refuse to pay back to the community. This is why many people are now calling for fair tax rules worldwide.
Hello everyone, my name is Tushar. I was responsible for answering question number 2. So my first slide explains the background of the case. The many multinational companies use transfer pricing to shift profits to low tax countries. This creates regulatory scrutiny, reputational risk, and public concern about tax fairness. Governments are now under pressure to reform corporate taxation. Transfer pricing explanation. Transfer pricing refers to pricing of transaction between related companies within the corporate group. This transaction includes goods, services, intellectual property, and financial arrangements. By adjusting these internal prices, companies can strategically shift profits across boards and reduce tax. Why this matters? These arrangements may be legal, they raise ethical concerns, they exploit mismatches between national tax systems, and weaken public trust in tax fairness. The government responded through OECD and BEPS actions that Australia's divided profit tax and strengthened anti-avoidance rules to improve transparency. Police proposal key takeaway. This case supports moving towards group-level taxation. Instead of taxing each entity separately, the profits are assessed at group level to prevent artificial profit shifting and ensure fair taxation. Now, my teammate will continue by discussing the rationale behind the consolidated group taxation proposal is important.
The rationale behind the consolidated group taxation proposal. The consolidated group taxation proposal is primarily driven by the need to address aggressive tax planning practices adopted by multinational enterprises that exploit inconsistencies between national tax systems. Under the traditional entity-based taxation model, each subsidiary of a multinational group is taxed separately according to its legal residence. So this structure enables profit shifting through transfer pricing, royalty payments, and intra-group financing arrangements, allowing profits to be relocated from high tax jurisdictions to low tax or no tax jurisdictions. As a result, tax liabilities often fail to reflect the true location of economic activity. What is the problem with entity-based taxation? So here is the 4 points of the problem with entity-based taxation. Under the current international tax system, each subsidiary of multinational corporation is taxed separately based on its legal residence. This means that profits are assessed at the entity level rather than across the entire corporate group. Okay, multinational firms often engage in international transactions between subsidiaries, such as the payment of royalties, management fees, and interest on intercompany loans. These internal charges can significantly reduce taxable income in high-tech countries. Transfer pricing also plays a key role in this process. By setting transfer price strategically, multinational corporation can shift profit from high tax jurisdiction to low tax jurisdiction, just like I explained from the previous slides. Okay, even when a little real economic activity occurs in a low tax country. So this is kind of same like previous slides. As a result, the tax outcome do not accurately reflect where the actual economic activity takes place, but profits may be reported in low tax countries while value creation, employees, and consumers remain in high tax jurisdictions. So how profit shifting occurs? Profit shifting starts where real business happens. In Australia, users and advertisers generate significant revenue for multinational companies. However, Instead of reporting these profits locally, companies transfer profits offshore through intra-group payments such as royalties, management fees, or interest. These payments reduce taxable income in Australia. The profit then accumulate in low tax or no tax jurisdiction, even though little or no real economic activity takes place there. This creates a gap between legal structures and economic reality. Profits are recorded overseas, while customers, workers, and value creation remain in Australia. So, as a result, profit shifting raises public concerns about fairness and transparency, especially when large corporations pay minimal tax despite strong local earnings. So, what is consolidated group taxation? Consolidated group taxation treats a multinational corporation as one single taxpayer. So, rather than taxing each subsidiary separately, they treat as a single taxpayer. So, under this approach, the group's global profits and losses are combined together, and it's giving a clear picture of the company's overall economic performance. So in the internal transactions between subsidiaries, such as royalties or management fees, they are ignored for tax purposes, which remove opportunities for profit shifting. Instead of focusing on complex legal structures, consolidated taxation emphasizes economic substance over legal form. Profits are then allocated to countries based on real economic activity, such as where users are located, employees work, and where the assets are used. And now we're going to talk about the rationality of this consolidated group taxation. So this approach ensures that profits are taxed where value is actually created. Another important rationale is fairness and equity. So domestic and small businesses operating only in Australia do not have access to international tax planning strategies, and they generally pay the full corporate tax. In contrast, some multinational companies have achieved very low effective tax rates. Consolidated taxation promotes a level playing field by ensuring businesses competing in the same market face similar tax obligations. From the government's perspective, consolidated group taxations helps protect Australia's tax base, where profit shifting by large multinationals has reduced government revenue, limiting funding for public services and infrastructure. This reform strengthens revenue integrity without increasing taxes on individuals or consumers. Finally, consolidated taxation improves transparency and administrative efficiency, where it provides tax authorities with a clearer view of a multinational's profits and reduces reliance on complex transfer pricing audits. In cases like Google, this approach would better reflect the company's true economic presence in Australia. So in conclusion, I can say that transfer pricing allows multinational corporations to legally shift profits away from high tax countries, including Australia. Real-world cases show that even when companies comply with existing tax law, the rules can still be exploited to minimize tax. This highlights is a key weakness in the current entity-based taxation system, which no longer reflects how global businesses actually operate. And consolidated group taxation offers a fairer and more effective alternative by aligning tax outcomes with real economic activity. Overall, this proposal represents an important step toward protecting Australia's tax base and improving fairness in the tax system. That's all from us. Thank you.